After decades of investing, I've learned that successful investing isn't about finding the perfect stock. It's about developing principles that help you consistently find opportunities and avoid mistakes and think differently than the crowd. Today, I'm sharing the investing principles that have shaped every major decision I've made. My name is Berna Barchet. I am a 20-plus year veteran of Wall Street at various management firms. I've worked in long only, hedge funds, family offices, prop trading desks, and I'm happy to be here at Wall Street Beats sharing what I've learned over my almost 3 decades of being in the markets. Okay, so the first principle I want to talk about is investing in what you know. An idea may be a terrific idea, but if it's in something that you are never going to feel comfortable with, and the places that I've consistently lost money is when I start veering into areas where I am inherently not comfortable. My deep dark secrets is I did not take chemistry in high school and I only took 1 year of biology. So, investor in biotech companies is probably not going to be my wheelhouse. And I have managed to steal defeat from the jaws of victory by not optimizing my investments in an area like that I don't truly understand. So what I've learned over time is to not go into sandboxes where I'm inherently uncomfortable, like biotech or insurance, and instead stick to what I know, which is pretty broad after over 20 years of doing this. But I would say 60-70% of the investments I make generally fall into consumer, broadly defined as, consumer discretionary, like retail and restaurants and travel and gaming, consumer packaged goods or consumer staples. That's a pretty big universe to go digging in. Does that mean that I never do anything in other sectors? No, I definitely have sourced some of my best investments ever from healthcare services, from pharma, from housing. These are generally ideas that come from my knowledge of how consumers think and behave. They're not completely divorced from my expertise in how consumers think. And I think also most people tend to gravitate to things that they're more passionate about, more interested in. How did I partially ended up in consumer and TMT because those are sectors I was assigned to when I was very young and new in the industry. One thing I love about a consumer is that you can get inspiration from anywhere. I've had some of my greatest investments not start from a 10K or from a presentation by the CEO or CFO to a group of analysts, but living in the wild as a civilian, not as a markets person, but as a human being moving through life, thinking about a totally different sector. One of the great investments that I had also, this is over 10 years ago now, just going through history, was in Lionsgate, the mini studio in Hollywood. I remember this was, about 10, 15 years ago. And I noticed that all the teens were reading The Hunger Games. And I had read about the book being developed into a film and in Entertainment Weekly of all places. So not a report from Goldman Sachs, an article in the Wall Street Journal, but in a totally trashy magazine that my now husband made fun of me for reading. I see that this book is being a movie by Lionsgate. Lionsgate is a company I had invested in the past. And I saw the casting was a young woman, Jennifer Lawrence, who wasn't very well known at the time, but I had just seen her in a small indie movie with which she had gotten a Oscar nomination. And I was like, wow, I see all the teens carrying this book. This young, interesting actress has been cast in this role. Let me read the book. And I am notoriously a slow reader. It takes me a month to finish a book. I tore through that thing in 48 hours. It was such a page turner. And I saw that it was perfect casting. Then I started to do the numbers. This movie did $100 million. What would it mean for the stock? If it $200 million, what would it mean for the stock? And it was clear that even a modest hit without any sequels was enough to move the stock. Now, we all know what happened. There were 4 movies. They were all a big hit, and it indeed moved the stock quite a bit. But this is an example of, seeing what the teens were carrying and reading something in as obscure a place as Entertainment Weekly started me on a financial research journey that led to a very profitable investment. So kicking the tires. This is the idea that investing can't happen in an ivory tower. And one of the reasons that I believe this is true is is because executives lie. The way that CEOs and CFOs get compensated is often restricted stock or options. So they're going to do everything in their power to get the stock up. And I'm not saying everybody's a liar, but everybody's try to put lipstick on a pig when that is the situation that they're in. So it always never ceases to amaze me when I was out, at idea dinners and idea lunches and Wall Street conferences, how many people invest in retailers, for example, without actually going to the retailer. And so the best example I can think of is Why You Get Out of the Ivory Tower was just unbelievable game that was played during the Ron Johnson era at JCPenney. That guy could talk such a good game at the same time that he was driving the business into the ground. And all you had to do was go into a couple of stores to see that what they were doing wasn't working. Yet for months on end, I would go to investor dinners and conferences and have this idea pitched, because what they were talking about doing in theory, which at the time was things like get rid of discounts and make different merchandising changes that didn't really make sense. It all sounded nice in theory, but you could see that in practice it was driving the business into the ground. So I use that as a great example of where just getting out of your office and going to some stores could have saved you the heartache of a stock that would go down 90%. So I think a really important thing to making money, and even more importantly, not losing money, is to keep an open mind. So your returns are a combination of how much you make when you win, but also minimizing how much you lose when you're wrong. And so I think that knowing when to cut your losses is a very important skill to develop in this business. Okay, another principle I think about is becoming a specialist, or if not single sector specialist, develop a few specialties. There is an advantage that specialists have. I mean, one proof that being a specialist can help you outperform generalists is the fact that so many of the big entities, the big funds, have organize themselves this way, whether it's Citadel or Point 72. Most of these organizations have most of the pods, the little groups that invest within them, organized around sectors. Some of them are organized more functionally around things like distressed debt or convertible arbitrage or other trading specialties, but a lot of the people who work at those organizations are organized by specialty. And so why does being a specialist work? I would say that being a specialist allows you to spot trends early. That can be a consumer trend, that can be a healthcare trend, that can be a trend in industrial. It can be any sector, but if you can spot trends early, shifts in market share, new products that are emerging, new services that are emerging, that is going to give you a leg up. It'll also help with your pattern recognition. Oh, I remember I invested in a company that had a large product that was very profitable, but very mature. When they added this product that was faster moving, the stock worked. So in those kinds of setups, being a specialist who can see those breakout moments and also put them in the historical context of what's worked before can be really helpful. That said, as I said, I do 70% of my investing in my specialty. And then when I get super fat pitches in other sectors where I feel like I can understand them and I can know them, I will go outside of it. In terms of which sectors I think offer the best opportunities, to me, I've always gravitated towards the sectors that don't revert to the mean, is what I call. So what is a reversion to the mean sector? Let's define that. Financials or energy, they tend to move together as sectors. Now, will there be outliers at any given point? For sure. But it's very hard for any energy company to do well when the underlying commodities are going down. It just doesn't happen. Similarly, when you're in an unfavorable rate cycle, it's very hard for banks to do well. Now, there might be one that goes from financial distress to not being financial distress. There's always exception, but those industries tend to move as a group and you're looking smaller between them. The thing that I love about consumer discretionary, about media, technology, is that there's no reversion to the mean. We can think about tons of companies that used to be big behemoths that aren't even here anymore. You think of something like Deck or Gateway in technology, or J.C. Penney in consumer. I mean, the lists make a really long list for both tech and for consumer. The fact that you're not just looking for how fast the pie is growing, that you have the opportunity in these non-mean reversion sectors for slice of the pie as a company to meaningfully grow bigger or shrink, makes them the most interesting to me. Another principle that I look for is pattern recognition. They say history doesn't repeat, but it often rhymes. Like, there's nowhere where that is more true than in the market. One thing I started looking for, and I defined in my very first fund, I told my investors, and I still stick to this 25 years later, is I look for situations where the future is not going to look like the past. Because when you're driving off the past, like especially even more so now than 25 years ago, there are computers are going to run multi-factor models, AI screening tools that are going to take all the data from the past and spit out what's going to happen in the future and how that correlates to how stocks move. And I'm never going to beat the computer at that game. What I'm going to beat the computer on is when the future looks totally different than the past, and you can just throw out history because it's just not indicative of what's going to happen in the future. So how do I generate ideas? Well, I think I talked in an earlier principle about investing in what you know to keep your eyes on the world around you. One of the reasons I love consumers because there's always, whether it's a new fashion, a new TV show, a new brand, there's always a new trend out there. And sometimes it's investable and it's not, but there's always the opportunity when you're observing people out in the wild in their real lives to find these ideas, because consumers drive about 60% of the economy. Sometimes consumer behavior can drive you to a stock that isn't consumer stock. One of the best investments I've had over the last 5+ years has been now a healthcare expert. We have one of those here at Wall Street Beats, but I'm not it. But what I noticed was consumer behavior, and being in New York on the frontier of so many people going on Ozempic, I picked up on the GLP thing early. And that was, there were only a couple of stocks, Lilly and Novo, play that trend. And, based on basic research, I picked my horse and of the two, and it turned out to be a good one. So, observing what's going on in the world around you can lead you to stocks, and it's not just consumer stocks that it can lead you to. In terms of looking for that inspiration, besides just literally looking at what the people around are doing, taking, consuming, another way to get there is reading, and not just reading Barron's, the Wall Street Journal, sell side reports, etc. I think inspiration can come from magazines or articles about technology, about fashion, about health advances. Inspiration can come from anywhere. I spoke earlier about reading a little blurb in an Entertainment Weekly that led me down a rabbit hole that included reading a book and watching a movie, and then research financials, very successful investment and out of Lionsgate out of it. Those kinds of stories are out there, and I think that it is important to be a sponge and read as much as you can, talk to people. I mean, I rarely go anywhere where I'm not asking people a million questions. They do, how their business is, because every interaction is an opportunity to learn more and maybe pick up a nugget that will lead to an investment. So market inefficiencies. Is it an efficient market? I think that if we believed it was an efficient market, none of us would be in this. This is what would be the point. In terms of where the biggest market inefficiencies today, I think it's in the smaller cap companies, away from tech and anything AI related. I think we're in an environment where all the oxygen in the room is being taken up by the largest companies in the market, the companies that are involved in AI, because AI is exciting. It is changing the world every day at a pace unlike anything we've seen before. I remember the rise of the internet in the late 90s and early 00s very vividly. It was something I invested in. Things are moving so much faster now with AI, but this is hardly an unknown thing. Everybody sees it. And because so much energy is being spent trying to figure out the next winner from AI, whether it is an LLM maker, a data center, or somebody who makes a chip who goes into the server that goes into the data center. There's so much energy being spent on that there is so little energy being spent on the buggy whip companies of the world, the companies that make shoes, that have a niche software program, the Strong Chain that's quietly opening stores. Like, there are a lot of interesting companies out there that are just far away from glamour and glitz and shiny object of AI and are just not on people's radar screens right now. It reminds me a little bit, actually, in the late 90s when everyone was focused on the internet. Nobody was focused on things like regional banks and REITs that owned real estate and, retailers that were doing well and apparel companies. And there were so many opportunities that wasn't internet, and the tech wreck happened in 2000, 2001. But I'm not calling for a wreck or anything, but I'm just saying the setup there, that there are a lot of small companies out there doing well and generally ignored right now. So my favorite metric is free cash flow. Everybody has their favorite financial metric and in this business, and some people are looking for revenue growth and other people are looking for ROI or for margin expansion year over year. There are a million things you can screen on. For me, I look for free cash flow or free cash flow yield. So looking at the amount of free cash flow relative to its market cap that a company can generate. This is my favorite because it's something you can't fake. Free cash flow is free cash flow. It's this quarter that wasn't in your bank last quarter. It's very tangible, and it strips out a lot of the noise principles, like how fast you depreciate your equipment or amortize your intangible assets, or EPS that are excluded from your EPS calculation. There are a million ways that you play around with what you present, but cash is cash and it's not fakeable. So that's why it's my favorite. And if you have high cash flow and not a ton of debt to service, it gives you a lot of options. You can pay dividends, you can buy back stock, and if the opportunity presents itself, you can make a good acquisition. So looking back, what has actually made me the most money? It's really hard for me to say this is this one thing, because some people are very rigid investors where they have a formula where their top line's not growing this, or the operating margin isn't that, or if the leverage is more than this, I'm not buying it. That's how they run their business, and it works for them. I'm not saying that's not a great way to do it. The one thing that is a core principle for me that has really worked is to lean into when you have an asymmetric risk reward. I really try to look at every investment in terms of risk reward. And I try to find ones where an opportunity on the reward side that is 3 times what the risk side might be. So maybe I think the stock can double in the next 2 years. And if I'm completely wrong, I lose 30% based on, what I think a trough, what the lowest earnings they could have is, what the lowest cash flow they might have would be. My worst case scenario is down 30. My best case scenario is up 100. Maybe I'm looking at something that's more leveraged and the risk is really that it could go under. Well, in that situation, I want to make sure that it's going to at least triple if things go well, when I think that it could. So I think about everything in terms of reward to risk, and the more outsized reward to risk ratio becomes, that is when it's more compelling to me, which is why sometimes I do go shopping around in stocks that are already blown up, where maybe all the shoes that there are to drop have hopefully dropped. That's something I look for a lot. I think true edge is rare. Knowing something that nobody else in the market is pretty rare. What isn't rare is having a variant opinion about the set of facts that is there in the market that everybody knows. So if you ever have true edge that is legal, so maybe you understand issue related to the stock in a way that you think that the market is generally misunderstanding it. Those situations where it's really knowledge as opposed to opinion are rare. And so when you have true edge, you have to lean into that. That's another thing I would say is. So to sum up everything that I've talked about, great investing isn't about predicting the future with 100% accuracy. It's about recognizing the patterns. It's about staying curious, keeping an open mind, and putting yourself in situations where the odds are constantly in your favor. So if this is all interesting to you and you want to learn more about we're buying now, the professionals at Wall Street Beats, what stocks we're looking at, please sign up below for our 30-day free trial. I think you'll find a lot of interesting stuff there and hope you'll join us.